Points. Joining us right now, talk about the market impact of Saira Malik. She's the Chief Investment Officer at Nuveen. Good morning to you. So let's talk jobs report and layer in, to the extent you can, this nervousness around we don't know what's going to happen with the Silicon Valley Bank, which, of course, the news has news is pending. That stock has been halted, but worries about contagion there and how Jay Powell may react to that.
Good morning. The employment report is the short-term shot in the arm that the markets needed. We were watching for three things, and that was labor force participation, January revisions, and wage inflation. And we got two of three of those in the right direction. However, the market's still going to grapple with a higher potential terminal rate and a faster pace of rate hikes. And if you look at history, pre the GFC, the average federal funds rate was running at almost 6% for about 50 years on average. And post the GFC, it was under 1%. So I think this is about the market adjusting to more of a return to the old normal environment that we'd seen for most of our careers and beyond. Looking at Silicon Valley Bank, I think that's a binary event. Tough to call on that. But contagion, likely limited in the sense that they have a unique business model. We don't love the financial sector because of higher rates in general and the impact on net interest margins. But if I was looking, I'd be looking at companies with strong wealth management businesses like Morgan Stanley, other regionals like Fifth Third, which are much better positioned, or turnarounds like Wells Fargo.
What do you think about this hold to maturity idea, that some of these banks may be holding too much?
I think that's a risk, and depending on your customer profile of your bank and how you're positioning your business, it can be. And that's, you're looking at some of these companies like Silicon Valley Bank, which then can go into an unwind if there is a run on the bank. And that's just another reason why we're not a fan of financials in general. Net interest margins are likely to get crushed for many of these banks. So the ones with the more diversified, resilient businesses are going to be better positioned. But overall, sector as a whole, not a favorite of ours.
What's your broader outlook on the market if we were to have this conversation, call it at the end of the year?
In the nearer term, we're still worried about the impact of monetary tightening. We're just 1 year into when the Fed first just raised interest rates by 25 basis points. The impact on earnings is not be seen yet. Revenue growth is a risk for us on the earnings outlook, especially going into 2024. Companies took a lot of pricing power. Question for us is, can they hold on to it? And what's going on with the consumer and the employment markets? Those are going to be the keys to when we get a recession, how deep it is. I think likely we still do get a recession, but it may be delayed because of the strength in the employment market like we saw today.
You said when, not if.
Yeah, I'm in the when, not if camp for a recession. I think it's going to be challenging looking at yield curves and the amount of tightening that the Fed has done and likely will continue to do. Their mandate is to battle inflation. Even whatever happens with the banking sector today, the Fed is still going to be focusing on battling inflation, which remains reasonably high. Continued rate hikes, I think, eventually does unwind the economy into a recession as employment eventually cracks.